Hello and welcome to our next auditing video. This one is on the topic of the types of audits and assurance services. So first of all, let's talk about the purpose of an audit. The audit function, the entire idea behind an audit, whatever type of audit you're talking about, we're trying to add credibility to the information that by its nature may be biased, by the fact that whoever is presenting that information wants to paint the best picture of their company. For example, if we're talking about a financial statement audit, it's management and the accountants within that company that are preparing and presenting those financial statements, and there's an inherent bias. Of course, they want their company to look good. Investors, on the other hand, want to know the truth about the company to make predictions about whether or not it's a good investment down the road or whether something's going on that they may want to switch investments. So again, the audit function adds credibility to that information. Because we're talking about independent, outside, external reviewers taking a look at that, there's no bias there. They're giving an idea of whether or not they think everything's reasonably stated. So that's the purpose of an audit. Again, we're adding credibility, we're adding assurance to that audit so people can trust the information. It removes some of that inherent bias, or it mitigates that inherent bias. So we're using the expertise and independence of a professional, in this case an audit professional, to add value to the information because it's adding credibility. Again, we're mitigating the fact that we have that inherent bias from the information provider themselves. Now, there are many types of audits. We're going to be going through just a few examples, but auditors are third-party independent experts because they have no bias with the company. There's no reason that we would not trust the auditor's opinion on those financial statements. So that's what we're going through here. But before we get too far, I do want to mention one thing. We're using the term audit, and we're using the most detailed or the most high-level review type there is. But really, an audit is a type of attestation engagement, and attestation itself is a type of assurance. So the idea here with assurance, it's very broad. We're just trying to provide some assurance to this information that, that there might not be any mistakes, or that, hey, we're adding some assurance. An attestation engagement is more assurance, if you will. It's a higher level of assurance, or a more detailed level of assurance. But an audit takes that to the extreme. We have to follow very, very stringent standards for the audit. So I just want to bring all three of those terms so you can see all three of them. We're focusing on an audit right now, but there are other levels of assurance that may not be as regulated, as stringent. So just keep that in mind. Now, when you think of audits, the first one most people think, if they're not in the business, you think of the IRS income tax audit. So what they're auditing is your tax return and eventually all the detailed documentation behind it. We have IRS regulations, the IRS code, the tax code. Those are the standards, so to speak, that you have to meet. And if you do not meet them, you're going to have fines and penalties. And possibly, if you're committing fraud on your tax return, we might be talking about criminal penalties. Other than that, it might just be fines. The next one is the one we are really spending most of our time on in the course and all these videos I create, the financial statement audit. Now, this relies on the expertise and independence of an external auditor, a CPA, a certified public accountant. And what we're trying to get at here is an opinion on whether any misstatements, any material misstatements, let me add that in, an opinion on whether any material misstatements exist in the financial statements. So there are a couple things I want to point out for this. This is not by any means a guarantee of the fact that there's no error whatsoever in those financial statements. So it's not a guarantee at all. It's a reasonable assurance that there are no material misstatements in those financial statements. So it's not a guarantee, but it's also not any sort of opinion on whether or not that's a good investment or not. You might have a company that is having a horrible year, thus it's kind of a questionable investment. It doesn't look like they're going to continue very far in the future. They're heading toward bankruptcy. So, horrible year, probably not the greatest investment. But if they're reporting everything accurately and properly on their financial statements, in other words, they're very transparent, they're disclosing we've had bad results, we might even have concern about the future, we might be a going concern is the term for that. If they're being truthful and honest about that, they're still going to get a good opinion on those financial statements. It's called an unqualified opinion. Sounds bad, but it's actually good. We'll talk about that in a separate lecture altogether. But the point is, the auditor's looking at whether or not everything's being told truthfully or is something materially misstated. So that's a financial statement audit. That's what we spend most of our time on in these courses. Now, an operational audit, we tend to be getting more on the internal side here, but we're looking at progress toward goals. So instead of standards or regulations, these are generally some sort of goals or objectives, usually within the company, and we're just looking at the progress toward those goals. Okay, we wanted to hit, a 20% sales increase. Where are we at now? Are we on track to meet those goals? Now, the operational audit, the internal auditors might have recommendations for improvements. Now, operational audit, when I mention internal audit, I want to make it clear. Operational audits are one piece of the work that an internal auditor might do, but they're also heavily involved in control testing and things like that. Now, compliance audits. This could be either internal or external, but there's some sort of external requirement here, a policy, a regulation, or a statute that you're trying to make sure you're complying with. And one way of thinking about it is that an IRS tax audit is a compliance audit as well. But the reason I'm listing it here separately is that it can be much broader than that. There might be other regulations or statutes or policies you're looking for. But again, this could be internal or external. You might have an IT audit, an information system, information technology audit. Now, as you can imagine, this requires a specific high level of expertise. So not just any auditor with an auditing background can do this. You have to understand the systems that you're trying to test, understand how it works, how it's supposed to work. This could involve things like reviewing security. So who has access to certain items? Is the code controlled? Changes to the code, is that controlled? Look at the processing overall. Are there any loophole type things, any weaknesses in how that system is working? Now, some of the results from this type of audit might be a recommendation for a change to strengthen the controls. You might be removing access. Maybe you find that too many people have access to a certain area and it's weakening the controls. It could involve a system-wide shutdown if you believe this is a very pervasive risk, a very immediate risk. It might involve shutdowns until the system can be fixed. That certainly happens from time to time. Now, I want to mention that these IT audits can sometimes be part of a larger control audit, which is the next section. So these internal control audits, again, these can be internal and external. In fact, they're generally both. What I mean by that is you're going to have your internal auditors that are doing reviews of your internal controls. That's one of their main jobs, one of their most important jobs, I guess you could say, is that they are testing the internal controls of a company to identify weaknesses and fix the weaknesses. So you have internal control audits. You could also have external audits. You will have external auditors, assuming you're subject to those requirements. Your external auditors that are doing your financial statement audits, they will also be doing a review of your internal controls to determine whether they see any weaknesses. And part of that is reviewing internal audit themselves to see, do you have a strong internal audit to find those weaknesses. Now, it can be tied to an IT audit if the systems establish many of the controls. So if your company is pretty highly automated, pretty dependent upon the systems, then obviously an IT audit is part of your internal control audit. Now, the last section, or the last statement I say here, is that these are now required to be part of financial statement audits. In fact, that was a result of Sarbanes-Oxley, the Sarbanes-Oxley Act from way back in 2001, the early part of the century. So what happened there is that prior to that point, external auditors generally weren't involved much with the internal control reviews. They didn't give an opinion on internal controls, anything like that. They said that was completely up to the company to have internal controls. Our main purpose is to find out whether there are any material misstatements. But after a lot of scandal, a lot of fraud happened with Enron, WorldCom, just a lot of those, after that point, Sarbanes-Oxley said this happened because there weren't strong internal controls. So the auditor really has to integrate their consideration of those internal controls. That does help to determine whether or not there's likely to be any material misstatement. So now they do have to give a separate opinion on the internal control, whether there are any weaknesses there, whether it's a strong enough internal control system to try to prevent any fraud or material misstatements. So that's a change. Again, it's been around for, well, quite some time now, but it was Sarbanes-Oxley at the early part of the century that caused that. One of the interesting ones is fraud or forensic audits. Now this kicks in at a much deeper level than a financial statement audit, but this is usually only triggered after crime is suspected, whether that be theft, embezzlement, or even financial statement fraud from management. You might have that situation. The reason this is so deep is because with fraud, by its nature, somebody is trying to circumvent those internal controls. So they're trying to hide their results. So because of that, we have to go deep to try to uncover something that a skilled person has tried to hide. With our normal financial statement audit, yes, we consider the potential of fraud, and if it is there, then we would kick in a fraud or forensic audit potentially. But at that point, we just don't dig as deep with the financial statement audits because it would be extremely time-consuming to dig that deep and that broadly. So that deep across all the different issues that we could see. Now, if you're a fraud or a forensic auditor, and you do find errors, intentional errors, that's the definition of fraud, then we're likely talking about criminal or civil penalties there. And I'm throwing one final one in here, and I will be honest, this probably doesn't mean much to many people at all. You've probably heard of Medicare. I'm talking about Medicare audits here in general. Now, the reason I throw this in is that actually this is my field of expertise. This is where I've been working for the past 16 years or so. I enjoy it. It's very interesting. But what we're talking about here is a hospital or other healthcare facility. They're required to fill out a Medicare cost report. Now, this Medicare cost report, a lot of times we compare it to a tax return when we're explaining it. It's kind of similar process. But the idea here is that this cost report helps to determine Medicare reimbursement and future rate setting for that hospital. So we're reviewing this, we're auditing it. It involves a little bit of financial statement audit. We're looking at some of the financial statements that have been reviewed, been audited already. So it involves some of that information, but it also involves a pretty high level of cost accounting as well, looking at some of the detailed documentation that you generally wouldn't see on a set of financial statements. They're more internal data. We're looking at their trial balance. We're looking at actual documentation for things like the bad debts, the accounts receivables, the charges, all the different cost elements for different departments of the company. So that's just one more type of audit. Again, I threw it in here at the end. It won't mean much to many people, but it is another type of audit, just like any of the others. So these are just a few of the types of audits you might see. There are many more types of audits, and especially when you talk about international, uh, many types of audits you might see. But again, going back to one of the earlier slides, there are also more types of just general assurance services or attestation engagements. It just depends on what is required by the users of those statements, whatever they might be, whatever information you're providing, what's required by those users and or what's required by some sort of regulation that's intended to protect those users. So hopefully this has helped to give you a little bit of an overview and broaden your horizons a bit on what type of audits exist. But I thank you for your time, and we will talk more about some of these in specific detail in later lectures. So thank you.